Good morning, everyone. Thanks for joining the webinar. So, when we look at markets today, one thing is becomes very clear that the investors are operating in a highly uncertain and more saturated environment. Uh, Equity markets have delivered kind of a strong return over the past years, right? But valuations in many segments are now kind of stretched and also volatile, has started to increase due to the kind of more global uncertainties, geopolitical tensions, and the shift in the interest rate cycles also. So at this time, gold has already witnessed a strong rally driven by central bank buying, inflation concern, and also the safe haven demand. So which makes investors kind of wonder whether the ease gains in gold are already behind us. Also, when we look at silver, on the other hand, the it has also been kind of showing a good strong momentum, but often moves faster than gold, but also has much more volatile than other asset classes, which means that the upside can be attractive, but at the same time, it can also have a eventual risk also. So, adding to this much complexity in a broader global uncertainty field, where this geopolitical kind of development in change in monetary policy across major economics. Also, when you are witnessing right now the market fall due to this US and Iran conflict, all of which create more frequent shift in the market leadership. Because of this dynamics, and investors today are not um, kind of simply asking whether the market will go up or down. The real question has become much more strategic is that where should the capital be allocated next, right? Because right now it's become more uncertain. So should the investors continue to rely on equities despite this higher kind of more uncertainty? Should they chase the momentum in the precious metal after a strong rally, what we have seen, or they should wait for better opportunities? So this dilemma is exactly what makes opportunities um, what most of the portfolios are facing today. And it highlights why traditional single asset investing often struggle in such an environment. Instead of trying to predict which asset will outperform next, the more important discussion today is about how capital should be allocated across multiple asset classes in a disciplined and more strategic manner, that is, in a dynamic manner. And this is precisely the idea behind today's discussion also. So understanding how a smarter asset allocation can help investors to navigate structure a kind of more saturated market and still create a long-term wealth and long-term journey. So to understand why asset allocation becomes so important today, we first need to understand what we mean by a saturated market. At a saturated market, it is not necessarily a market that is about to crash, but rather a market where many major asset classes already reflect a lot of optimism and positive expectation in their prices. If you look at equities today, valuation is in several segments are elevated after kind of a good strong rally before the kind of the Iran US conflict. Also, kind of, which means that you can see the future returns may not be kind of that much straightforward as they were during the earlier phase of the cycle. At the same time, precious metals also like gold and silver have also seen a kind of a significant rally driven by global uncertainties, central bank buying, and inflation concern. So investors entering now are often wondering where kind of whether they are already late to the kind of the move what's happening right now. Also, adding to this complexity is the uncertainty around the interest rate globally. It's also very important thing we need to consider. Central banks across major economies are navigating inflation, global growth concern, and geopolitical pressures, which means interest rate cycle are not very predictable at this stage. Interest rate movement have a kind of a direct impact on multiple asset classes, including equities, bonds, currencies, and even commodities. So on top of that, the liquidity cycle are also shifting over the past decade. Market benefited from abundant liquidity due to the accommodative monetary policy by RBI. But at the global financial condition, which is tightened and more fluctuate also, the flow of liquidity across asset classes can change very quickly in a short time. So when you combine all these factors, see the elevated equity valuation, precious metal already witnessing strong rallies, uncertainty around the interest rate, and shifting liquidity condition, it creates a kind of environment where relying on a single asset class becomes increasingly risky. Investors who concentrate too heavily in any one of the market may face higher volatility or a long phase of underperformance. This is why a saturated market, the conversation should shift from simply picking the next winning asset to thinking more strategically on how your capital should be allocated across asset classes in a dynamic manner. So at this stage, most investors are now struggling because they don't lack opportunity. They are struggling because they are kind of trying to answer the wrong questions, I would say. Almost every investor today is asking the same three questions. Is it the right time to invest? Or how much should I invest now? And which asset class should I choose? These questions sounds more logical, right? But they often push investors into a more prediction mindset. When markets are rising, investors feel they might be late and stay to invest. When market correct, they become fearful and delay the investment further. So the result is that the capital often stays on the sideline or get deployed at the wrong time. Similarly, you see when one asset class performs well, like gold, recently also during the equity phase when it performs during the strong bull market, investors feel the urge to shift heavily into that asset, assuming that the trend will continue. But you need to understand market rarely moves in a straight line. And the leadership between asset classes keeps rotating. This is why relying purely on prediction, whether it is kind of predicting the next market move, the next top performing asset, or the kind of perfect entry point, often lead to poor decisions. Investors end up kind of chasing the past performance, entering after these big rallies, or exiting during the temporary corrections. So many people, what they are doing the mistake right now is that due to this conflict right now, Nifty has come from 25 to now 23, that level. So people are taking the money at the wrong time, I would say. So over this kind of time period, this behavior can significantly reduce the long-term portfolio return. Instead of trying to predict the perfect movement or the perfect asset, a more effective approach is to focus on structure and discipline and how capital is allocated. So when portfolios are built around a thoughtful asset allocation rather than short-term prediction, investors can participate in opportunities while also managing the risk in a better manner. And this shift from prediction to allocation is exactly what we'll explore further as we move ahead in coming slides. So one of the biggest risk investors face, especially in this kind of a more saturated, more constant kind of more uncertain market, is concentration risk. Putting too much capital into a single asset class, assuming it will perform well. If you look at history, every asset class goes through phases of strong performance as well as the phases of underperformance. For example, equity markets can deliver a strong return in long term, but during crisis, they can also experience sharp drawdowns. Events like this global financial crisis in 2008, also this pandemic shock, or kind of a sudden geopolitical tension, what we are seeing right now, can cause the equity market to fall significantly in a short period of time. On the other hand, gold is often considered as a safe haven asset and has historically performed well during the kind of this uncertain period. But also you need to know that this when the uncertain period starts, both equity and gold will not go kind of negatively correlated. At starting point, both will be going down only because at that time people will be trying to keep more liquidity in the hand. So in a kind of a more mid phase, you can see that correlation will be kind of a more negative way. But it's also a kind of go through a kind of a longer phase of consolidation also. So where you see the price of gold when moves sideways for several years also. So which tests the patience of investors in that scenario. So the drawdown kind of the recovery rate can be up to 6 years for gold. If you see the past metrics on how gold has performed. Same way, if you see silver also, while sometimes delivering even a strong rallies than gold, what we are seeing is also kind of known for its more high volatility, meaning it can even move up rapidly, but also have a kind of a more sharper correction, which makes it difficult for investors who enter purely based on momentum. See, even the debt instrument also, which are usually considered stable instrument, are not completely risk-free because they are influenced by the interest rate cycles. See, when the interest rate kind of rise, bond prices will be declining because they are negatively correlated, because they are inversely related. So creating the mark-to-market risk in the debt portfolios. So when we look at all these examples together, the common lesson is very clear. So no single asset class provides stability and growth across all market environment. So when investors concentrate heavily on any one asset class, they expose themselves to a specific risk of that asset cycle, by the way. So that is why diversification and thoughtful asset allocation becomes extremely important, because spreading capital across multiple asset class through dynamic way reduce the overall portfolio risk and concentrate and creates kind of a more balanced investment approach. So one of the most important realities investors must understand is that a market leadership constantly change over time. No asset class stays the top performer forever. If you look at the past 2 decades, we clearly see how different assets have taken turns leading to the market cycle. In the early 2000s, after the dot-com bubble, you can see that gold entered a kind of a strong cycle between 2000 to 2003 as investors moved towards the safe haven during that period. And then from 2003 to 2007, equities took the leadership during the strong global growth phase, delivering a kind of a good impulsive returns, by the way. And after the kind of the global financial crisis in 2008, uncertainty increased again, and the gold experienced another powerful rally from 2008 to 2011. Later, between 2014 and 19, equity markets once again dominated as economic recovery taken place, and the liquidity supported corporate earnings and valuations also. So more recently, also, after this COVID from 2024 to 20, sorry, from 2020 to 2024, we have seen a kind of a broader multi-asset rally, I would say, because gold has done significantly well. Equities also did good. Also, other asset classes also participated in a good way as this global liquidity and the policy change support also played a key role in that. So the key lesson from this timeline, what you're seeing is that the leadership in financial market keeps rotating depending on the market cycle, economic cycle, liquidity condition, and investor sentiment. So the challenges for investors is that this shift are rarely predictable in advance. It's true. Even the top portfolio managers, they struggle to understand how this everything goes in the way. So it's investors who concentrate heavily on any single asset often perform well during one cycle. Okay, I agree with that, but may struggle when the leadership shift. So that's where the issue and the problems will be created. So this is why relying purely on any one asset class can create an uneven investment journey. Instead, recognizing that leadership change over the time encourages kind of a more balanced and more diversified approach, I would say. So where portfolios are positioned to participate across a different cycle rather than trying to predict exactly which asset will be the next, right? So following to the previous slide, this slide clearly illustrates one of the important realities to investors again. So no single asset class consistently deliver the highest return every year. If you look at this table across different year, you will notice that the asset class at the top keep changing. So in some year, gold gave highest return. In other years, equity lead the market. In some period, international assets, real estate, and even fixed income instruments outperform. So at the same time, the asset class that performs best in the 1 year can move to the bottom in the next year. For example, an asset that delivered a strong double-digit return in one period may even generate negative return in the following year. So this constant rotation is exactly what makes investing challenging for those who try to chase the kind of the latest top performing asset. Many investors naturally tend to move their money into the asset that has recently performed well, right? But by the time they enter, the cycle may already be changing. This behavior often results in buying high and selling at low, which reduces long-term return. What this table teaches us is that the wealth creation is not about guessing which asset will be the number one next year. Instead, it's about participating across different asset classes in a dynamic and more structured way through proper asset allocation. So, by diversifying across multiple asset, also multiple sector, investors can capture opportunities wherever they emerge while also reducing the impact of underperformance in any single asset class. So over the long period of time, this disciplined approach of asset allocation and dynamic structural shift can create a more stable and effective path to wealth creation than trying to predict the next best winner, I would say. So one of the most important lesson in investing is that the asset allocation drives the majority of portfolio return. It's true even if you are not agreeing also, this is the truth, I would say. So many investors spend a lot of time trying to predict which stock will perform best or which asset class will deliver the highest return next year. But in reality, long-term investment success depends far more on how capital is allocated across asset classes rather than an individual investment selection. So when a portfolio is properly allocated between different asset classes in a dynamic manner, it naturally captures growth from different parts of the market. Another key advantage of asset allocation is that diversification reduces drawdown. So market moves in cycle, as I already stated, and sometimes one asset class may face sharp correction. But when multiple assets are part of the portfolio, the impact of any single downturn is reduced in a significant manner. So, for example, during the equity market correction, gold and certain debt instrument often provide more stability to your portfolio, which helps to cushion the portfolio and reduce the volatility. So, this smoother investment journey is extremely important because it helps investors to remain disciplined and stay invested during the uncertain periods. In fact, you see, one of the biggest risks because the reason why investors fail to achieve long-term wealth creation is not because of poor investment, but because they exit market at the wrong time due to the volatility and the fear. See, when well-structured asset allocation strategy reduces this emotional pressure by making the portfolio more balanced and more stable. As a result, investors are also able to stay invested for a longer period, which allows the power of compounding to work effectively over time. So this ultimately will lead to a more important conclusion. Asset allocation is more powerful than prediction. Instead of trying to forecast the short-term market movement or chase the best performing asset of the moment, kind of the at the particular point in time, a well-disciplined kind of allocation approach, which is focusing on participating across asset classes in a more structured way. This approach not only manages the risk, but also increase the probability of capturing opportunities across the changing market cycles. And which is why asset allocation remains one of the most powerful tools for the long-term wealth creation. So at this stage, it's important to understand the difference between the two very common approach investors follow, the prediction approach and the allocation approach. So the prediction approach is what investors naturally try to do. See, it involves kind of attempting to predict the market movement, deciding whether to exit or kind of enter the market, and constantly trying to identify the next best performing asset class. In theory, this sounds more logical. I know it kind of sounds more logical, but in reality, it becomes more extremely difficult because market are influenced by multiple unpredictable factors. See, right now, the US Iran war, the fundamentals are really good in the equity market, but still equities are falling. So there is a lot of unpredictable factors play in the market. Even the interest rate change, also this liquidity crunch, this crude oil issue. So everything, the investor sentiment. So this as a whole, the result, this prediction-based investing often leads to market timing and emotional decision making. So investors may enter a asset after it has already rallied or exit during the temporary correction, as you know already. So which can have a significant effect on your long-term return. So as I'm saying this again also, see the allocation approach focuses less on predicting the future and more on building a structured portfolio. Instead of trying to guess which asset will perform best, this approach emphasizes diversification across asset classes, disciplined allocation, and effective risk management. So by spreading investment across different assets, the portfolio becomes more balanced and resilient across market cycle. This also encourages long-term discipline because investors are not constantly reacting to this short-term market noise also. So over time, this structured allocation approach helps investors to stay invested during the volatility in a better and also capture opportunities across different market environment. So far we have discussed how market go through cycles, how leadership keep changes between asset classes, and why relying a single asset class or trying to predict the market often lead to a more inconsistent outcome. So this is exactly where we are having a structured multi-asset strategy, which becomes very important. And this is where it brings you to Spear. So Spear is our multi-asset PMS strategy designed to help investors to navigate this changing market condition in a more disciplined and a structured and more dynamic way. So instead of focusing only on one asset class like equity or gold, Spear allocates more dynamically across multiple asset classes, including global opportunities and market cycles. This The objective is simple. So allocate across asset in a way that the balanced growth and risk is maintained. So by participating in different asset classes, the strategy aims to capture opportunities that emerge at the different point in the economic cycle. So, for example, there may be a phase where equities offer a strong potential growth, phases where precious metals provide a more protection or kind of a more. Right now, you are seeing what the momentum stuff, and phases where precious metal and sorry, where the fixed income becomes more attractive due to the interest rate cycle changes. So rather than trying to predict which asset will outperform next, Peer focuses on participating across these different asset classes on a more dynamic way, where we position to the benefit from multiple opportunities over the time. So at the same time, this approach reduces the dependency on any single asset classes. When investors concentrate too much on any one asset, the portfolio becomes highly sensitive to that asset performance, right? So by diversifying across assets, Spear aims to create more balanced portfolio that can adapt as the market evolve. And ultimately, the thing is that the philosophy behind Spear is not about chasing short-term trends, but about building a kind of more disciplined multi-asset strategy that captures opportunity across cycle where managing risk is in a more structured way. So now, as we saw Spear, it is important to understand the philosophy that drives this strategy. So at its core, Spear follows a disciplined investment framework built in kind of four key principles. The first is multi-asset allocation. Instead of concentrating capital in any single asset, the strategy dynamically, I'm saying this again, we are dynamically allocate across different assets such as equity, fixed income, global, and other emerging opportunities depending on the market condition and valuation. So this approach ensures that the portfolio is not overly dependent on any one market trend and is positioned to participate across different economic cycles. And the second is contra investing. Market often move based on sentiment and momentum, which sometimes lead to overvaluation in a popular assets and undervaluation in a more neglected sector. So Spear aims to identify such situation and take position where opportunities exist, but are not kind of yet widely kind of known to the market or recognized. But looking at the as they are temporarily out of favor, the strategy attempts to capture value before broader market participation begins in that. And the third element is the value-driven decision making. Instead of chasing the short-term trends or market, or Spear focus on intrinsic value or more fundamental-driven, long-term fundamental-driven approach. So investments are selected based on valuation attractiveness, risk-reward balance, and long-term potential rather than the short-term excitement. So this disciplined approach helps to avoid the common mistake of buying assets simply because they have kind of recently performed well like that. So finally, the risk management plays a central or kind of a important role in the Spear strategy. So markets are inherently more uncertain, right? And managing the downside risk is just as important as capturing the upside opportunities also. So by balancing exposure across assets and continuously monitoring portfolio risk, Spear aims to create a more stable investment journey for investors. So when this multi-asset allocation, contra investing, value-driven decision, and disciplined risk management, the result of the strategy that focus on process rather than prediction. So because in investing, the reality is that no one can consistently predict the market. So, but a strong process, I mean, see, the strong process and a disciplined framework can significantly improve the probability of achieving a long-term investment success. So let's understand how Spear strategy actually works in practice. The process begins with the market cycle analysis. Market move through kind of different phases such as expansion, slowdown, recovery, and consolidation. And each phase tends to favor different asset classes. So by analyzing the macroeconomic indicators, liquidity trends, interest rate cycles, global development, and the strategy that attempts to understand where we are in the broader market cycle. So the second step is obviously asset valuation. We have a dedicated research team for that. So even within a asset class, so see, the valuation can vary significantly over time. So Spear focuses on identifying the assets that are more offer kind of attractive risk reward opportunities based on the valuation. See, rather than simply following the momentum of the recent performance, we focus more on the valuation. And the strategic allocation also plays a big role here. So based on insights from the market cycle analysis and asset valuation, the portfolio is allocated across different asset classes in a more structured manner to structured manner, where to capture the more balanced growth potential, obviously with the good risk management. And the market are kind of more dynamic and the condition can change over time. So this is why the strategy also incorporates the tactical adjustments also. So where allocation may be kind of slightly adjusted to capture the emerging opportunity or manage the evolving risk right now. Finally, the entire portfolio goes through proper periodic review. Regular monitoring ensures that the allocation remains aligned with the changing market condition and investment objective. The structured process, starting from cycle analysis, following by the valuation assessment, strategic decisions, what we are making, then tactical call during the time, and the continuous review. This helps to ensure that the investment decisions are driven by disciplined framework rather than kind of not like the short-term noise. Finally, the ultimate thing is that the goal is to maintain a dynamic yet structured portfolio that adapt to market cycle while we need to stay focused on the long-term wealth creation journey. So if we look at the current market environment, several factors which highlights is that why a multi-asset strategy like Spear becomes especially relevant today. First, the market is in many segment appears to be more saturated. Kind of just neglect the right now this war. You just see it's kind of more saturated. It was fully you can see the Nifty 50. It was fully traveling in the same range amount of the support level, by the way, right? So this equity valuation in several pockets are also been more elevated. And after the strong rallies before the war, what we have seen in certain asset classes, the margin of error becomes very smaller also. So at the same time, this volatility across market cycle has been gradually increasing due to the factors such as the changing interest rate cycle, geopolitical development, and the liquidity problem. So another important trend we are witnessing is that the market leadership is rotating much faster than before right now. So in one phase, equity may outperform, but in another phase, precious metal may take a lead, but at the same time, the fixed income or the global assets may offer a better risk-adjusted return opportunity also. Right. So because the shifts are happening more frequently, relying in any one single asset class become more increasingly challenging for the investors. So this is exactly where the multi-asset strategy plays a big role for you. Well, when you look Spear, so we operate between the moderate and conservative level. So typically, when you see Nifty 50's long-term return will be from 10 to 12%. By the way. But the thing you need to understand is that you can get the same return in Spear also, but with a less kind of volatile manner, I would say. So if the beta of Nifty 50 is 1, it will be less beta for Spear, I would say. So in that manner, Spear delivers a good risk-adjusted return in the long term for the investors. So as per the SEBI guidelines, the minimum investment in the PMS would be 50 lakhs. And the benchmark for us is NSE Multi-Asset Index 1. So when I need to talk about this benchmark, that benchmark is contained about 50% into NSE 500, 40% into Nifty 50's arbitrage and 10% into retirement, by the way. And it's important to you guys to know that we don't have any exit load in that. And the fees what we charge is 1.5% per annum, which will be taken out quarterly basis on the daily average NAV value. So as we expect the investors to stay for 5 to 7 years to have a good sustainable return journey. And as I stated also that we are a more dynamic PMS product, so we don't have any kind of minimum investment in any single asset class. We can move from 0 to 100 in any asset class based on the market movement, market opportunity, and so on. Well, this is our latest performance metric. You can go through this, and this is the team behind the Spear PMS product and other PMS products as well. Then we can wind up today's session. Thank you, everyone. Thank you, everyone, for your time. Thank you, guys.